Welcome to The Explainer. Today, we're popping the hood on a truly fascinating and honestly highly debated topic, factor investing. We're going to dive deep to demystify the complex mechanics and, more importantly, expose the hidden pitfalls of quantitative models. Because, there's a real irony here. Strategies that get branded as smart beta can sometimes act surprisingly dumb when they actually get stress-tested by the real world. To make all this concrete, we're going to use Alpha Architect's Global Factor Equity ETF, ticker symbol AAVM, as our real-world case study today. Let's get into it.
For years now, quantitative models have had this massive, almost hypnotic appeal in the financial world. And the pitch is incredibly seductive, right? You rely on pure data, complex algorithms, and decades of academic research to strip out human emotion completely. In theory, you build this perfect defensive shield against market volatility. But it begs a really fundamental question for us. Is factor investing actually foolproof? A lot of people assume these quant strategies are a silver bullet. But as we parse through the data today, we're going to see that this kind of mechanical investing carries some very real structural vulnerabilities.
To immediately contrast that theoretical perfection, let's look at a pretty jarring reality check. This quote comes directly from a recent risk analysis on the AAVM ETF put out by Koala Gains. They evaluated the fund's actual defensive capabilities and concluded, quite bluntly, that it failed to protect capital during recent bear markets, negating the primary purpose of an equity-hedged strategy. Wow, that is a striking assessment. It tells us right out of the gate that what works perfectly in a neat little computer backtest doesn't always translate into a protective shield when actual market panic sets in.
So how does it actually work? Well, AAVM isn't just going out and buying individual stocks directly, it acts as a global factor portfolio. Think of it kind of like a nesting doll, an ETF of ETFs. It stacks quantitative strategies from Alpha Architect, holding QVAL for US value, IMOM for international momentum, IVAL for international value, and QOMOM for US momentum. The stated goal here is this robust, unshakable diversification by combining the absolute cheapest stocks with the strongest momentum stocks all across developed markets. Honestly, it sounds incredibly comprehensive.
And the academics absolutely love this stuff. Decades of research illustrate a clear theoretical promise. Intermediate-term winners tend to just keep on winning, and intermediate-term losers keep losing. On paper, if you look back at the past 9 decades, buying the highest momentum stocks looks like an absolute home run. The data is clear, the academic white papers support it, and it forms the entire bedrock of why funds like QMOM and IMOM even exist within this portfolio.
But here's the tricky part. How does a computer identify the right kind of momentum? Well, Alpha Architect uses this brilliant analogy called the frog in the pan effect. You know the story. If you put a frog in a pot of water and slowly turn up the heat, the frog doesn't notice the gradual change until it's too late. Similarly, the theory goes that investors systematically underreact to smooth, continuous streams of positive news. So the model differentiates between continuous momentum, that really smooth, reliable premium, and choppy, volatile, discrete momentum. The whole strategy is explicitly built to hunt down that smooth, continuous momentum. The theory is elegant, no doubt about it. But let's pivot back to reality. Relying purely on algorithms introduces a very specific structural danger that is actually defined right in the fund's own prospectus: quantitative security selection risk. This is the very real danger that the quantitative model itself drops the ball. Why would it? Well, the model requires flawless data to work. If the data is even slightly erroneous or outdated, or if the historical trends the algorithm was trained on suddenly shift, the whole system breaks. The computer doesn't intuitively know how to pivot, it just keeps blindly executing the code, which can cause it to perform horribly compared to the broader financial markets.
Drilling down even further, the momentum style specifically has some profound vulnerabilities outlined in the source material. By definition, you are inherently investing in volatile securities that have just had above-average recent returns. But momentum can turn violently. When a sudden trend reversal happens, those high-flying stocks can snap back fast, leading to severe underperformance. Compound that with the fact that there are simply prolonged periods, sometimes years, where the momentum style is just completely out of favor. During those times, a purely mechanical strategy is going to bleed out, and there is no human manager there to step in and override the system.
Now, to maintain these incredibly strict, continuous factor exposures, the internal gears of the fund have to be grinding constantly. Take a look at this staggering number, 101.0%. That is the turnover ratio for QVAL, which is one of the primary underlying funds inside AVM. Think about that for a second. A turnover rate of 101% means the portfolio is essentially ripping up and replacing its entire holding of stocks every single year. It perfectly highlights the intense, hyperactive mechanics required just to keep the portfolio perfectly aligned with what the quantitative model demands. And here is the crucial point for us. This intense mechanical trading isn't free. High portfolio turnover carries very tangible risks that eat directly into an investor's returns. Every single time the model triggers a buy or sell just to rebalance things, it racks up brokerage commission costs. But even more critically for everyday retail investors, this rapid portfolio turnover exposes you to a higher current realization of short-term capital gains, which, as we know, are generally taxed as ordinary income. So the pursuit of this theoretical alpha through constant algorithmic trading can easily hand you an elevated tax burden that acts as a massive drag on your real take-home performance.
Okay, so let's transition from the internal gears to external shocks. What happens to all these structural risks when a massive macroeconomic event hits? Because the Koala Gains risk analysis focuses exactly on this scenario. When the macroeconomy suddenly goes sideways, like during the intense rate hikes of 2022, does this algorithmic defensive shield actually hold up? Let's look at what the data tells us.
Negative 21.4%. During that extended market correction, the fund's 5-year maximum drawdown hit a painful negative 21.4%. To put that into perspective, the broader category norm for similar defensively hedged products was a decline of only 13.9%. The fund dropped significantly further than its benchmark. The data clearly indicates that when macro shocks hit the equity markets, the algorithmic hedges simply broke down. Instead of a defensive shield, investors got hit with a severe capital decline.
And this failure is perfectly mirrored in the fund's 3-year downside capture ratio, which sat at 92. What does that mean? It means instead of acting as a hedge, the fund absorbed almost all of the broader market's pain, drastically underperforming the peer average of 59. It behaved much more like an aggressive, totally unhedged equity allocation right at the exact moment investors needed protection the most.
Compounding this whole performance issue is a severe structural red flag regarding liquidity. The daily average trading volume for the AAVM ETF sits at a microscopic $13,750. That is remarkably low. If the system experiences real stress, you might find yourself staring at incredibly wide bid-ask spreads, essentially trapped when you need to exit the most. A lack of scale like this makes it incredibly difficult, if not impossible, for a moderate or large investor to safely trade out of their positions during a market panic.
But wait, the risks of these advanced strategies go beyond just picking the wrong equities or lacking trading volume. As we read deeper into the Alpha Architect Fund Family Prospectus, we uncover this incredibly dense layer of hidden complexity. A lot of these strategies utilize options and overlay mechanics. This means you aren't just taking on the risk of a stock going down. You are taking on complex, synthetic, mechanical risks that operate completely out of sight, far beneath the surface of the ETF structure.
For example, let's talk about box spread risk. A box spread is basically a synthetic bond. It's created by combining a bunch of different options trades, purchases and sales on the exact same underlying instrument, but with different strike prices, all to create these perfectly offsetting spreads. Now, while that sounds absolutely brilliant in a finance textbook, adding these synthetic, mechanical layers on top of equities drastically multiplies your points of failure. If the computer's pricing models are slightly off, or if market liquidity suddenly dries up, these highly structured offsetting spreads can violently backfire, exposing the fund to totally unexpected losses.
And utilizing these options overlays introduces perhaps the ultimate hidden danger, counterparty risk. When you trade exchange-listed options, they are guaranteed for settlement by an institution like the Options Clearing Corporation. Counterparty risk is the terrifying danger that this financial partner actually becomes insolvent. While it might seem unlikely, the prospectus explicitly warns that if the clearing corporation is unable to meet its settlement obligations, the fund could suffer significant, totally irrecoverable losses. And that happens completely independently of how the actual stocks are performing.
Which brings us to our final point, and the ultimate question posed by the Koala Gains report. Are you really paid fairly for the risk? As an investor, you constantly have to weigh the beautiful, flawless math of a backtest against the really ugly reality of massive tax burdens, steep drawdowns, and systemic counterparty risks. Does the theoretical promise of alpha truly justify navigating this labyrinth of complexity and hidden danger? Keep asking yourselves the hard questions, because as we've seen today, the mechanics of smart beta are anything but foolproof.